Well, the benchmark 10-year Treasury yield hitting its lowest level since mid-December as a slew of worries seem to weigh on investors. The Conference Board's Consumer Confidence Survey seeing its largest monthly decline since 2021. The Philly Fed reporting its services index tumbled to the lowest in almost 2 years. And there's a promise of tariffs starting next week. CNBC on-air editor Rick Santelli joins us now with the rate impact. Rick, how much farther do you think the yields go on the 10-year?
You know, it's always hard to catch that falling knife, but considering the momentum to the downside, I wouldn't be surprised to see a violation of 4.25 down to maybe around 417 to 419. But I look at it a little different. I think 417, 418, 419 is a good area should we get down there to start establishing more of a short bias. But another way to look at it is over the next 3 to 4 weeks, I look for the high-frequency yield to be traded to be around 435. So even though I think there could be more room to the upside in price, the downside in yield, I think we're getting close to an area where the consolidation is going to be at a slightly higher yield. Now, what is really the dynamic here? And I think this is really important. Treasury yields, you know, they're based on what's going on in the economy and safe haven. So it's kind of a versus. And we consider what's going on with the economy. We have to look at 2 areas. We need three, actually, the balance sheet of the country, debt and deficits. We need to look at prices, inflation, deflation. We need to look at growth. Now, growth is the one that I think is under review right now because nothing's really changed on the balance sheet. We talk about tariffs, but it certainly isn't showing up. Prices, you know, PPI was hot, CPI was hot. But what's moving the market? Squishy numbers, squishy numbers. Uncertainty is the issue these days, and the confidence numbers are showing us some movement like I've never seen before. So what's that telling me? That's telling me that the uncertainty from growth, which is probably more temporary than permanent, is coming into the safe haven area. So it's all about shocks to the system, right? Well, not anymore. It's more about stocks. That's where the shock is coming in. So to me, it's pretty easy. We're going to question growth. Most of the data actually hasn't shown me a huge reversal in growth. Uncertainty remains, and everything is half empty with this administration because of that, and I get it. You know, whether it's regulation or energy, there's a lot of positives, the growth aspect based on the current administration. But this is going to continue to affect that. And today we did see a bit of reversal. We saw green in the Dow. But what we need solid green. We need the NASDAQ to join, and then that will change the Treasury outlook dramatically.
We got PCE on Friday, as you know. How much of a monkey wrench can that throw into this whole thing, Rick?
Well, you know, it can throw a monkey wrench in, but honestly, look at February 11th and 12th. CPI was hot. PPI wasn't that cool. It was on the warm side as well. But yet, we hardly had a reaction. And to me, that's very telling. What I would consider is the most important area for viewers is to watch real time how the market moves and on what it moves on. That's key. It didn't move on the work week shrinking in the last jobs report. Now, all of a sudden, that's a big talking point because many analysts are trying to match what's going on with the market in the fundamentals. But to me, the things that have moved the market are squishy. We have University of Michigan. We had Conference Board numbers. We had Philly non-Fed. Squishy, squishy, squishy. We have quant numbers coming up. To answer your question, I don't think we're going to see a huge cooling in PCE, but there's no doubt in my mind they'll probably be a little bit cooler than the CPI reads that we had not that many weeks ago.
Rick, I want to ask you about a note that I read today from Bank of America saying that if the stock market, if the S&P 500 specifically dropped roughly 6-7% or so, that they would expect Trump to have fiscal intervention. And I'm wondering how the bond market would take that, if that would be a positive thing in terms of bolstering growth or if that would be a negative thing in terms of fiscal irresponsibility.
Yeah, you know, I have a hard time dealing with the what if like that because I'm not sure what kind of fiscal intervention the president would have at this point. I think the administration must understand that uncertainty is just a code word for the process of change. I think this administration has an idea where they're going, but the eggs they're going to break on the way, I think that's something we're just going to have to live with, and it's going to remain an unknown. I wouldn't think that the president should do something like that. I think that would accentuate some of the negatives more. But I think what he could do, obviously, is give us more information to reverse or at least ameliorate some of the uncertainty in the tariffs and some of the negatives of this administration with respect to what's making investors run from their stock position to take a new attitude, safe haven and capital preservation.